Equity markets around the world sold off sharply on Monday as worries about a potential US recession spooked investors. This comes on the heels of one of the worst trading sessions in Japanese stocks since 1987, with the Nikkei falling 12.4% on Monday. Volatility indexes, such as the VIX, which is a measure of market risk, spiked to their highest level since the pandemic sell-off in March 2020. Many investors, advisors, and their clients are probably rightly concerned about this market sell-off. It's important to remember that a cool head and a long-term view are essential during periods of market volatility. It's also key to remember that volatility is actually a feature, not a bug, of investment markets, and historically, investors are best served by staying invested during market corrections. As a case in point, despite the Japan market being down 12.4% yesterday, it's up about 10% today. Not going to cash yesterday was essential for long-term returns. For context, this period of volatility began as worries about the US growth outlook started late last week. A disappointing jobs report in the US showed slower hiring and a rise in unemployment. Rightly or wrongly, this raised recession fears. Since their recent highs in mid-July, technology stocks have been some of the hardest hit areas of the market. After an extended rally, these stocks had become increasingly crowded, making them vulnerable to sentiment changes, and this is what we've seen play out over the last few days. On the other side of the fence, bonds have performed very well, with the 10-year yields in both the US and Australia now below 4%. In the US market, the market's pricing a 97% chance of a 0.5% rate cut in September, betting the Fed will really step in and ease financial conditions in the face of slowing growth. In Australia, the path of interest rates is less certain, but downward pressure will certainly come if this market volatility was to continue. So what should investors do? Well, firstly, investors should not panic. Overreactions to market volatility, making rash decisions, they're a natural bias for investors, but one that should be avoided if they can. In fact, as investors ourselves, Morningstar benefit from others panicking, and we can take advantage of this and have buying assets from much more fearful sellers. We've seen countless market corrections over the years, and history suggests that volatile down days tend to be followed by recoveries and rallies that are hard to time. Attempts to time the market rarely pay off. Investors should stay the course and follow a disciplined investment approach. Morningstar's investment team has constructed portfolios to weather a range of conditions and to be able to respond as needed. In times like this, stay invested, focus on the long term, and take a balanced view. Importantly, use valuation as an anchor and take advantage of the opportunity that the market presents.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.